All right, hello everybody. Clover Health's Q3 earnings was this week on November 4th, and I'm going to go over my opinions on what I see that I believe is important to the company and why I'm not bearish. So let's get into it. The market got it wrong. Yesterday's Clover Health stock drop after Q3 earnings was a knee-jerk reaction, possibly started by institutions, to a short-term miss on EPS, and it completely missed the long-term profit opportunity. As noted on the slide deck, year one members show a negative $110 profit per member per month. Yet returning members in year two show a positive $217 return per member per month. And that is how they projected it into in the slide deck. So as we move into the next year, we can expect some substantial growth in members, but this will help be offset by our returning members. This is a very healthy long-term position that Clover Health is in. Let me go over a few financials based on the company's own projections. Year-to-date revenue, Q1, 2, and 3, is $1.4 billion, and the company improved guidance for a full year revenue of $1.85 to $1.88 billion. Q2, they maintained insurance revenue guidance between 1.8 and 1.875 billion. As they have steadily increased their revenue each quarter, I do not expect that they would regress in revenue accumulation for Q4. Q3 revenue was $497 million. By adding roughly the same, I'm going to use a round number of $500 million, and assuming that there will be virtually no quarter-over-quarter growth, also not likely, as they have consistently picked up members each month, we would ballpark around $1.93 billion to $1.94 billion in revenue for full year 2025. This is a considerable beat on expectations set by the company. Other guidance includes average Medicare Advantage membership of to 106,000 to 108,000. Q1 they guided for 103 to 107,000 members average, and I believe this is in line with expectations for the company, as they reported a total membership ending Q3 of 109,226. I expect that they will meet these expectations as the average. The company both in Q3 this week and Q2 improved guidance for SG&A expenses, now showing a range of 325 to 335 million. Q1 they guided for 355 to 365 million, so they've dropped that significantly. Q3 reported BER was 93.5, and year-to-date BER is 89.4. They are guiding for a full year BER of 90 to 91%. BER. This is up 0.5 to 1.5% from the previous quarter's guidance. We can expect the BER for Q4 will likely stay above 91% for Q4. Don't forget, SaaS improvements are baked into BER. Year-to-date ending September 30th, there has been $66.24 million in spending on quality improvements. Not all of this is counterpart assistant, but we can assume that at least some of it is. It is clear that they are continuing to improve the platform as they show more evidence through their clinical white papers. Adjusted EBITDA and adjusted net income have both been heavily downgraded, but this was somewhat expected, as this year is not going to be profitable. They are likely dumping a lot of money into growth to improve the flywheel model and supercharge 2027 and 2028's profitability. This is just my own assumption, though. Although they did not yet officially guide for 2026, they did leave some notes on profitability drivers for the full year to keep an eye on. A 4-star payment year will provide them with a substantial 5% boost in revenue. They foresee continued strong cohort management and returning member retention, which is very important for their flywheel. 2026 final rate update, and this will be officially released on or before the first Monday in April. An expected Part D subsidy increase, and continued impact from cost efficiency initiatives to optimize variable, fixed, and growth SG&A expenses. It is clear that they are focused on this, as they have improved their percent of SG&A to revenue quite well year over year, than 440 basis points, and have consistently guided lower for this year. And finally, they didn't talk much about Counterpart aside from what we already pretty much knew. A quick recap on that slide: they noted higher diagnosis rates for diabetes, 75% higher, CKD, chronic kidney disease, 89% higher, CHF, 89% higher, and COPD, 70% higher. This is for disadvantaged members that live in areas that simply don't have the infrastructure to help provide cutting-edge diagnosis like you might find in more populated areas. Don't sleep on this information. This is what will help put Clover on the map. Also, less acute care utilization across patients with diabetes, CKD, CHF, and COPD. Fewer inpatient hospitalizations by 8 to 21% fewer, and 30-day readmissions 12 to 21% fewer. Important. Again, this is massive. This is value-based care at its core. Clover will likely work heavily to aid the disadvantaged areas in the U.S. to provide better care for all people under the Counterpart umbrella. Now, this is just a recap of Clover's Q3 earnings and how I'm interpreting some of it. So, thank you for watching. If you liked this video, hit the like button. And if you think I'm missing something that seriously changes the fundamentals of the company, then let me know down in the comments. This is not financial advice, as always. Have a great day, and keep doing your own due diligence to build your current conviction. Thank you very much.